Welcome to Kitco News. I'm Niels Christensen. The gold market has seen unprecedented ETF demand as investors search for safe haven assets in a world devastated by the COVID-19 pandemic. Here to talk about what this demand means for the market and prices is George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors. George, thank you. Welcome to the show.
Thank you for inviting me, Niels. Always good to talk with you.
So let's jump right into the gold market. What does this unprecedented ETF demand mean for the market and the price? Is there room for the market to grow with what we're seeing?
I think no question. I think that investors are extremely nervous right now. The pandemic is obviously first and foremost in people's minds. The impact on the economy. The stock market has shown some tendency to recover a little bit, but let's not confuse the stock market with the underlying economy. I think there are major differences between the two. I think everybody's pretty much convinced we're solidly in recession. I've heard some people predict that we will remain in a significant recession, possibly for the rest of this year and into 2021. That's the kind of language people are talking about. That makes investors very nervous. It makes the search for safe havens very, very important. And I think that we've seen that with inflows of almost $7 billion year to date into GLD, inflows of $750 million into the smaller product GLDM. And I think that we've seen that in the gold price that, currently flirting around the $1,700 an ounce level. I think the last time we talked, we were discussing the fact that gold was flirting with the $1,500 an ounce level. And we talk fairly regularly. So for gold to have gained a good $200 in just a few short weeks, I think has been a very, very good performance. And I think that the performance of the price, apart from reflecting safe haven demand, I think it also provides a solid endorsement to those investors who had built up small strategic allocations within the context of properly balanced portfolios. Niels?
Are you surprised at the rally that we've seen in gold? I mean, last week we went from a massive sell-off to hitting new 7.5-year highs last week, above 1,700. What's your take on the breadth of the rally that we've seen?
I think, what we saw was gold was above $1,600 an ounce before we'd ever even heard of coronavirus, because it was still building on the momentum that it had gained when the price broke through the top of a 6-year trading range last summer. The price had been topped out at 1,350 for about 6 years, from the spring of 2013 through until June of last year, when Jerome Powell at the Fed first indicated he was minded to cut rates. He's obviously had to make a lot more cuts than he anticipated at the time. But gold, as I say, was already above $1,600. Then we got the big sell-off in equities, and a lot of people had sudden, unexpected needs for cash, especially in order to meet margin calls on equities, calls for additional margin on equities that they bought in a leveraged fashion that way. So they sold gold. And gold dropped dramatically, $100, $150 or so from that $1,600 level. What we've seen since then is a very quick recovery. And I think this is almost like a replay of what happened in 2008, what happened in 2002 with the recession we had, and what happened all the way back on Black Monday of 1987. We saw a big sell-off in equities. And equities then took months to recover their equilibrium. We saw people selling gold in order to meet liquidity needs, especially for calls for additional margin. But gold on each of those occasions, and this present one as well, on all 4 of these occasions, gold has recovered its equilibrium much more quickly than equities, within a matter of days or at most a week or two, and has then gone on to hit higher highs. And what we're seeing, to my mind, is an exact replay of what we've seen 3 times before in recent history.
So, talking about 2008, do you think, and we're seeing more calls for gold to hit all-time highs, do you think we could hit $2,000 by the end of the year, just with everything that's going on and the close similarities to 2008?
I think it's got to be a possibility. I'm not redoing my forecasts yet, given that the pandemic, I think, is having an unprecedented impact on all aspects of life, the financial markets, and specifically the gold market included. But I had been suggesting a trading range that might top out at about $1,700 for this year. We've already seen the price exceed that by a considerable margin just a week or so ago. So I'm going to have to redo my forecast at some point, but I think that I'm going to have to take very seriously the possibility that we might see $2,000. We're in uncharted waters here. I hate to use a hackneyed phrase, Niels, but we really have never seen anything quite like this. And I think that we could easily see the previous highs taken out, just a little under $1,900, and it's then only another 100 up to 2,000. I think it is a very real possibility that we could see that before year end, especially given an awful lot of sensible people, medical personnel, scientific personnel are suggesting that the impact of this pandemic could be with us for a lot longer than some of the politicians are suggesting.
So what do you think gets us there? I mean, we've seen the Fed throw, I use this phrase, they've not only thrown out the kitchen sink to fight COVID, but they're throwing their neighbor's furniture at this as well. Do you think we see negative interest rates? Is that the next step, and will that drive us to 2000?
I don't know whether we will ever see them. The Fed has been particularly cagey on that subject. Even when Janet Yellen was the chair, there was talk of negative rates, but she wasn't certain whether there was any legal issues involved. And basically, the Fed has said nothing about negative rates since then. So I don't know whether we will see negative rates, but I don't think we need to for gold to go higher. I think the relationship between gold and interest rates is poorly understood these days by a lot of people. A lot of people think, higher rates mean a greater opportunity cost to owning gold. So people will sell gold if they have higher interest rates. And frankly, that has not proven to be the case. The Fed started raising rates in December of 2015 when gold was at $1,050 an ounce. And they stopped raising rates in December of 2018, just 3 years later. And in that period, gold went up 20%, when this is in a period when the price is supposed to go down. So I think the relationship is really not well understood. And I don't think it's as important as it has been at various occasions in the past. I think that there is enough in this market right now, whatever the Fed may do, however much they may go into the bond market. There's been suggestions they might even go into the equity market. They could obviously go to negative rates. I don't think that really matters. There's enough momentum in this market right now to carry us up to the kind of levels that you're talking about.
So that's the bullish case. What about the bearish case? I mean, today we're seeing oil prices just absolutely crater. It hit a low of $4. Is there concern that deflationary pressures could hamper gold? How do you play this? I mean, does deflation even matter with the amount of money printing that we've seen since March?
I think the seminal text on all this is Professor Roy Jastrom's book, The Golden Constant, which basically discussed gold's role as a protection against inflation, not as a predictor of it. Jastrom didn't see gold as a predictor of inflation, but he said it offered the best protection there was against sustained high inflation of any asset class that he looked at. But he also said counterintuitively that in periods of deflation, gold loses value less rapidly than other assets. So it's actually a pretty good protection if we get deflation as well. I don't know whether we're going to get deflation, but we're obviously going to get continued extraordinary measures. We called them unconventional measures in 2009. I guess we're probably going to have to call them extraordinary measures or exceptional measures or something when we write the history of 2020. But I think that, irrespective of what the Fed does, gold has it within itself to go to much greater highs than we've seen so far.
Mm-hmm. Thank you, George, for your comments on gold this week.
Thank you, Niels. I appreciate the opportunity. It's good to speak with you. Stay safe and stay well.
You too, George. You too. And thank you very much for watching Kitco News. For the latest information in the precious metals market, go to kitco.com. Thank you very much. Stay safe and stay healthy.